Behind the calm-looking EUR-USD chart lies a macro tension you shouldn't ignore. The Federal Reserve decided to hold interest rates at 4.25 to 4.50%. While projections for 2 rate cuts this year remain, the tone has shifted, more cautious, more reserved. In short, the Fed is still hawkish. Meanwhile, the European Central Bank also held its rate steady. Inflation is cooling, yes, but policymakers are staying data-dependent, keeping their next move uncertain. On the U.S. side, core inflation remains elevated. GDP growth has slowed to just 1.4%, and trade tensions are rising. The result? U.S. yields remain high, and that continues to support the dollar. Bottom line? The USD still has a strong macro foundation, and for EUR-USD, that means short-term downward pressure is likely to persist. Now, let's take a look through the lens of smart money. On the H1 and H4 timeframes, we saw a clear liquidity grab in the 1.1450 to 1.1470 zone, marked by a strong bullish candle that swept retail stop losses clean. Right after that, the structure shifted. A break of structure occurred as price dropped from a previous higher low, signaling potential reversal. The 1.1450 to 1.1470 zone now acts as an institutional supply block, a likely entry point for large short positions. Above that lies a fair value gap between 1.1480 and 1.1500, a liquidity pocket that could serve as the next magnet for price before any continuation move. What does this tell us? Institutions are already building short positions, targeting the liquidity sitting just above 1.1480. Shifting to the intermarket perspective, the US dollar index, or DXY, dropped to its lowest level in 3 years, but that didn't last long. As soon as the Fed reaffirmed its hawkish stance, the dollar rebounded sharply. At the same time, the US 10-year yield remains elevated, giving the dollar even more fuel to climb. In broader markets, we're seeing risk-off sentiment. Commodities are mixed, and equities are under slight pressure. That environment typically favors safe haven flows, and once again, the USD benefits. So, while the signals may appear mixed at first glance, one thing is clear. The dollar's rebound is real, and it's putting renewed pressure on EUR-USD. From a technical standpoint, EUR-USD is currently trading within a consolidation range between 1.1480 and 1.1550, but the short-term structure leans bearish. Both RSI and MACD show signs of a possible short-term correction to the upside with divergence forming. Still, there's no valid breakout above 1.1550 to confirm a bullish shift. According to TradingView signals, the key area to watch is 1.1450. A clean breakout and retest of that zone could be the trigger for a high probability setup. In the meantime, price remains sideways with a bearish bias. Traders should wait for a valid retest or breakout before making a move. Let's talk sentiment. According to the latest COT report, hedge funds and CTA desks are starting to reduce their net long exposure on EUR-USD, signaling a shift toward short bias. On the other side of the spectrum, retail traders are still heavily buying. And when retail goes long en masse, it often signals that smart money is preparing to sell. Meanwhile, in the options market, volume is rising around the 1.1550 strike. That's a clear indication that institutions are hedging, possibly preparing for a reversal or sudden spike in volatility. All signs point to one thing. Institutional flow is quietly shifting, while retail remains overly confident. And that could set the stage for a sharp move. In summary, institutions are beginning to short while retail traders continue to buy. This imbalance creates a classic setup, a short-term opportunity for a leveraged FOMO-driven move. Here's the trade plan based on our full analysis. The suggested entry is a short position around 1.1450 to 1.1470, ideally after a bearish confirmation, like a pin bar or bearish engulfing candle. Your stop loss should be placed above 1.1500, just beyond the fair value gap and recent swing high. As for targets, TP1 is at 1.380 to 1.400, aligning with the nearest short-term support zone, and TP2 sits at 1.1300 to 1.3500, near the weekly swing low and a larger fair value gap targeted by smart money. Wait for clean confirmation, either a bearish candle on the H1 or H4 timeframe, or a sharp rejection from the supply zone. Risk management is key. Keep your exposure below 2%, use a trailing stop once TP1 is hit, and consider scaling out gradually at TP2. Let's wrap it up with a quick banker-style summary. From a macro perspective, a hawkish Fed and elevated yields continue to support the US dollar. On the smart money side, institutions are shorting from the 1.1450 to 1.1470 supply zone. Intermarket conditions remain risk-off, and high yields further strengthen the dollar while putting pressure on the euro. Technically, the structure is bearish, but a clean retest of the order block is still needed before confirmation. And finally, sentiment shows retail traders are still heavily long, which opens the door for an institutional short squeeze. All key elements align for a potential bearish continuation in EURUSD.